Good morning. Welcome to Genius Galaxy Coaching. Dear student, today we are going to discuss accounting topics, uh, O level for O level students. Cambridge International Education Syllabus, Cambridge O level accounting 7707. This syllabus is for 2027, 2028, and 2029 exam. Today, I am going to the content overview first, then we'll discuss the first chapter, the fundamental of accounting. So, if we go through the syllabus, we'll see the chapter 1, the fundamental of accounting, chapter 2, sources and recording of data, number 3, verification of accounting records, number 4, accounting procedure, number 5, preparation of financial statements. Number 6, analysis and interpretation. Number 7, accounting concept and modern practice. That's all. So now we are going to discuss fundamentals of accounting. So before going to the accounting, I am going to discuss some elementary concept related to business. We know every business has its own objective. The main objective is to earn profit. So, every business operates some financial activities, and that activities should be recorded in a systematic manner so that they can understand what is happening during the operation, to know the actual fact, the performance of the business. So, the accounting actually related to the recording of the financial events, summarizing them, and find out the output. That means to explore the performance of the company or business for a certain period of time, and assets, liabilities, and owner records position on a particular date. So, the concept of accounting is very much related to the recording of financial transaction. Financial transaction and the scope of it, I mean the scope of accounting, depends on the size and complexity of the business entity. Say, a small sole proprietorship firm, they use a simple method to know their profit, and a big corporation, they follows a lot of accounting books and statements for their scientifically organized to get the optimum result, financial output, what is happening their business. That's all about the basic concept. Now, so from our discussion, one thing we need to clear before going to explore further, that is, what is financial transaction actually? So, any event which impacts on the financial position of a business is called a financial transaction. It must be measurable in terms of money. For example, if salary for 5,000 USD paid, then the cash position will be decreased by 5,000 and salary expenses will increase by 5,000. This is the change happening in the business. But if an expert manager died accidentally, it may causes a huge loss of a business. But this is not a transaction because the loss amount is not measurable in terms of money. So this event impacts business, but this is not financial transaction. So every financial transaction must be an event that is measurable in terms of money. Another example, if an fire accident occurred and 5,000 or 50,000 amount losses, then this is the transaction because this event changes the financial position of the business, which is measurable in terms of money. Now, we want to know what is accounting. So, accounting is the process of recording, classifying, summarizing, and interpreting the financial transactions of a business in monetary terms to show its financial performance and position. Here are two critical points. One is financial performance, another is position. That means financial performance reveals how much profit or loss incurred during the period. Normally, it is a financial year uh, starting from 1st January to 31st December, or sometime 1st July to 30th June. It is normally 1 year. Different company follows different financial periods. So, the financial performance reveals the 1 year, normally 1 year performance, how much profit or loss generated during the operation of the business. And financial position reveals what assets, liabilities, and owner's equities exist on a particular day. So, the accounting is the systematically recording of financial transaction, classifying them, summarizing and interpreting the financial transaction of a business. Now, purpose of accounting. The purpose of accounting are to keep systematic records of business transactions. As we discussed earlier, every business do some financial or business operation which is uh, related to financial activities. So, these activities, these financial events or transactions should be recorded systematically for determining the performance of a business after certain period. Number two, to determine profit or loss of the business. So if we want to determine how much profit or loss the business is generating, we must systematically record those financial events throughout the year, and we have to classify them properly to know the profit or loss of the business. Number three, to show the financial position of the business through financial statements. To provide financial information for decision making by owners, managers, and other stakeholders or users. This is the main full objective or purpose of accounting. Now we are going to discuss about accounting equation. The accounting equation represents the relationship between a company's assets, liabilities, and equity or capital. So what is asset? What is liability or equity capital? We will discuss in details later on. Here the main equation is assets equal to capital plus liabilities or owner's equity plus liabilities. As capital is sometimes referred to as owner's equity. This equation can be expanded in the following ways. Assets equal to liabilities plus common stock plus retained earnings plus revenue minus expenses minus dividends. If it is a corporation, then common stock value is the share capital of the company provided by the owner or shareholder. This is the capital actually. And retained earnings means the part of earnings retained in the business for further expansion. This is the stake of owner's equity. Plus revenue, if any activities increases revenue, then owner's equity will increase. Less expenses means if any expenses occurred, then owner's equity will go down. Less dividends or withdrawal. This expanded version provides a deeper look into the elements of the accounting equation and how they interpret. Here's how each element impacts the equation. Revenue and expenses. Revenue increases assets or reduces liabilities, boosting equity, while expenses reduce equity by decreasing assets or increasing liability. Through the expanded equation, business gain a more detailed understanding of various financial activities impact overall equities. Here, that is the equation actually assets, A for assets, L for liabilities, O for owner's equity. So asset means the economic resources that belongs to a business that is invested for making profit. For example, furniture, buildings, machineries of a business. Liability is the financial obligation of a business that has to be paid off after a certain period of time. That is, it is the claim of the third party over the total assets of the business. Owner's equity, if the claim of the third party is deducted from the total assets of the business, the rest will be known as the owner's equity. That is the claim of the owner over the total assets of the business is known as owner's equity. So, owner's equity is that portion which is actually come from the owners initially and build up through business operation in the form of profit gradually. Here, the owner's equity related to owner's investment, that is how much owners invested in the business in the form of capital or common equity or common stock, then revenue. If the business generates revenue, it increases the owner's stakes. Drawings or dividend, this reduces the owner's stakes in the business because they are taking out money from the business. Expenses, reduces expenses reduce the owner stakes in the business. Here, if we look the graph here, owner's equity increases by increased by capital investment. If owners invested new fund in the business, its stake automatically increase by that amount. Revenue, revenue increases owner's equity. Drawings or dividend decreases owner's equity. Expenses decreases owner's equity. So here A is equal to expand, we can write here also L plus C minus D plus R minus E. Here A mean asset, L mean liability, C mean capital, R mean revenues, E mean expenses, D means drawings, which we already discussed for the corporation here. For the here, this is the this here the assets. Now we will we will see some impact here uh, in detail so that we can understand clearly. We will show here what is the impact. Suppose started a business initially, owners invested in the business 5,000. So if we look here, asset side, if he provided cash, then cash account will increase by 5,000. If paid through bank, then bank account will increase by 5,000. So here in equation effect, owner's equity increased by 5,000 as owners invested new initial fund in the business. Simultaneously, cash increases by 5,000. Purchase machinery on credit. If purchased machinery, then what will be the impact on the equation? Machinery amount will increase by 5,000 and liability will increase by 5,000 since the purchase is in credit, not cash. So accounts payable liability increases 5,000 and asset machinery increases 5,000. This is the impact, same impact both sides. Again, if 3,000 amount paid for accounts payable, then what will happen? Cash side 3,000 will be decreased since the cash is going out, and accounts payable also will decrease by 3,000 because we are paying cash to repay our liability, accounts payable. So our liabilities is decreasing 3,000, cash also decreasing 3,000. If salary is paid in cash, what will happen? Say 2,000, then cash will decrease 2,000 since cash is going down, and owner's equity will go down 2,000 because expenses reduce owner's equity. So now here both sides decrease by 2,000. If furniture purchase in cash, say 1 lakh, then what will happen? Cash will decrease 1 lakh, furniture will increase 1 lakh. This is the one side effect. One asset's cash is decreased by 1 lakh and another asset furniture is increased by 1 lakh. There is no effect on right hand side, I mean liabilities or owner's equity. It just impact asset side. One asset cash is decreased by 1 lakh and furniture another asset is increased by 1 lakh. If owner's equity increases, total liabilities decreases. See, business loan 5,000 paid off by the owner personally. What does it mean? The business has business loan 5,000. This amount is paid by the owner. So what will happen? This means actually owners investing now 5,000 more in the business. So owner's stake, that means owner's equity will increase by 5,000 as capital because owners paid this amount on behalf of the company from his own fund to pay the business loan. So business loan liability will be decreased by 5,000 and owner's equity will be increased by 5,000. These are right hand side effect, no effects on left hand side. One liability loan will be decreased, another another form of liability, that is owner's equity, it will be increased by 5,000. Goods purchased on credit 7,000. Then what will be happen? One credit means accounts payable will be increased. This is our liability. So if goods purchase on account, then 7,000 accounts payable will be increased. And this is also expense, good purchase expenses. So it will decrease owner's equity. This is the same right hand side effect. Owner's equity decreased by 7,000. Accounts payable is increased by 7,000. Payment of a accounts payable by taking loan of 20,000. Here, both are liabilities. Loan liabilities, accounts payable also liabilities. So, it sometime happen, accounts payable means we purchase goods on credit. So, sometime happens, there is a payment timeline. So, we have to pay the amounts against accounts payable. But if we have not sufficient money, then sometimes business needs to borrow from other sources to pay another debt or liability. So here, loan is taken for repaying the accounts payable. So what is happening here? Loan is a liability, it is increased by 20,000, and accounts payable is another liability, is decreased by 20,000. So this operation affects liability side. One liability is decreasing and another liability is increasing. Owner's equity will increase and decrease in equal portion. Say owners withdraw goods amounting 5,000. So what will be happen? Here withdraw means the fund is going out from the business against owner's equity. That means owner's equity is going down because owners is pulling fund from the business. So 5,000 will be decreased. Simultaneously, owners taken not cash, owners taken here goods. So goods mean the goods is purchased preparedly for the business. So when goods is purchased, it is an expenses. So during the purchase, owner's equity was decreased for that amount. So now the owner is taking these goods. So we have to decrease the purchase amount. That's why 5,000 will be here, equity will be increased. Net effect equal to 0 because drawings making owner's equity negative and purchase decreased will increase owner's equity. Since the owner will not give any profit, the owner against the purchase, so it is a practice to reduce purchase if owner taken out any goods. That's the logic here. Now, here is a fill in the gaps. We have to fill up this assets, capital, and liabilities. So assets equal capital plus liabilities. So here is given 35,000 asset and 12,500 liabilities. So if we want to make this equation equal, what will be the amount here for capital? So it is logical. If we deduct 35,000 from 35,000 by 1200 500, then we will get the amount. So here will be 35,000, just use calculator here, 35,000 less 1200 500, now 22,500. So 22,500 will be the capital if we want to make this equation equal. Similarly, here for B, here assets is question mark, capital is given, liability is given. So we know that asset equal to capital plus liability. So the asset is equal to 44,400 plus 1,900, 300. So amount will be, if we add them, 44,400 plus 1,900, 3,000, 19300, sorry, 44,400 minus 19300, 25,100. So if we deduct them, but actually we have to add them. We have to add them to get capital. So 44,400 plus 900, 300 equal to 63,700. That will be our asset position. So in the case of C, asset is given, capital is given, how much will be liability? So it is easy. We can deduct 55,000 from 66,300. So the figure will be 67,300 minus 55,000. So the amount will be 1,200, 3,300, 12,300. This is the liability amount. So it is not very hard. So I think you understand the problem related to accounting equation. Now I am going to discuss some accounting concept related to accounts so that we can understand what does it mean and how it should be treated in the accounting equation. First one is capital. Capital means owner's equity. So it is when the owner provides cash, goods, assets, and benefits to the business, it is recorded as capital. Drawings. Drawings, it affects owner's equity. So when the owner withdraws cash, goods, assets, or benefits from the business for personal use, it is recorded as drawings. Cash. Cash is an asset. When cash is received or paid through asset transaction, it is recorded as cash. Bank. Bank also asset. When transactions cause an increase or decrease in bank deposit, it is recorded as bank. Purchase. This is related to expense. When goods purchased for resale are bought, when goods are bought in cash, by check, card, on credit, or by bill, it is recorded as purchase. So purchase is expenses. One important thing here, we mentioned as purchase for resale. Say our business is trading ready-made garments. So if we buy a lot of kids dress, then this purchase is called purchase amount. But if we purchase a furniture, but our business is not selling furniture, this furniture will be used in the business as assets. Then this purchase will be treated as assets, not expenses. The basic difference is when any purchase is related to uh, reselling, then these goods purchase will be purchase expenses. But if any asset purchase related that will not be resell, it will be used in the business, then that purchase will be assets. Say furniture purchase or machinery purchase, then this is not purchase, then we will treat it as machinery account or furniture account. Number 6, sales revenues. So when sales is occurred, it generates revenue. That means it increases owner's equity. Furniture, this is asset. We already discussed it. Machinery and equipment, asset. Purchase return, contra expenses. What does it mean? Purchase return means we sometimes purchase for reselling a goods, but after purchasing, we found some discrepancies or defects on the goods. So we need to return them to the seller. This is purchase return. So what happens? What is the effect of this transaction? Say if we purchase 10,000 amount of product and we returned 100 amount of product, then our net purchase will be less than 100. So 9,900. This is the effect. These effects reduce the purchase actually. That's why it's called contra expenses. Sales return, same thing. We sells and customer returns those to again to us. Then we have to deduct this amount from the sales. Accounts payable, this is a liability. This is generated when we purchase anything in credit, that is accounts payable. This is the liability we have to pay later on. Accounts receivable, this is the contra of the accounts, opposite of the accounts payable. Here it is asset. We sell goods without cash, that means on credit. So this creates accounts receivable. That means we will receive the fund later on, not now. So this is an asset. These accounts receivable will be converted into cash later on. Bills payable, liability. Purchase through bills, acceptance or bills. There is a little bit difference, bills payable and accounts payable. Accounts payable means accounts payable or sometimes called trade payable. Accounts receivable or called trade receivable. These are same concept. These actually happen due to the normal operation of the business, buying and selling. That means purchase and sales related to accounts payable accounts receivable or trade payable or trade receivable. But bills payable and bills receivable, these are quite different scenario. Sometimes business give acceptance or creates bill. So these bills, if the company accept bills and which is payable later on, this is called the accounts bills payable. So bills payable is liability and bills receivable is asset. Inventory means the goods available on the stock. This is an asset because this inventory have a value and it is reusable. So this is an asset. Loan liability. Loan liability definitely, because if business takes loan, then you have to pay later on. Investment, this is asset. Sometimes business has surplus fund, then business can invest this fund in the form of FDR, fixed deposit receipt, or can buy share or stock of the other company. So this is investment. Asset. Salaries, expenses, definitely. Stationery supplies, expenses. Rent, expenses. It may sometime, rent may be sometime revenue. Sometimes happen, business may have additional space, then business can let out to other business or entities and get rent. That is rent receipt. This is, if it is rent receipt, then income. If it is rent paid, then expenses. So normally rent is treated as expenses. Freight, expenses incurred while bringing in purchased goods or delivering sold goods are recorded under the purchase inward freight. Freight, actually the freight related to purchased goods. This is expenses. Interest paid. So if we take loan, we have to pay interest. This interest payment is expenses. Interest received. If we invest, then we get interest. Say we are making FDR in a bank, then these FDRs will generate interest. This one income, revenue. Advertisement, this is expense for promotional purpose. Bad debts, this is expensive. Bad debts means if collection from a account receivable becomes impossible due to death, bankruptcy, or any other reason, it is recorded under the bad debts. We sometimes sell our product on credit, which creates trade receivable or account receivable. Sometimes this amount is not fully recoverable. The portion which is become unavailable for collection, that amount is treated as losses, expenses. This is the bad debts. Discount allowed and discount received. If sometimes it is a very common, sometimes discount is given to the buyer, then this discount is expenses. Or sometimes if we have account receivable, then we sometimes allow discount so that they can pay their dues earlier, which is beneficial for us to meet our emergency fund situation. So it is very common allowing discount. So discount allowed is treated as expenses. Simultaneously, discount received is treated as revenue. Now depreciation. What is depreciation? Depreciation means the value of fixed asset decreases due to uses. Every assets have a useful life except land. Say furniture, computer, machinery. This is not lifelong. They must have a life. After a certain period, it will be obsolete. So in the practice, we determine the useful life. Say if we purchase a furniture today, we said this furniture will serve up to 10 years. It is the useful life of this asset. Then, if we purchase this furniture in 1 lakh, so we will divide this 1 lakh for 10 years. So, in the straight line basis, if we divide this 1 lakh over 10 years, then per year will be 10,000. This is the depreciation. After 1 year, we will think the value of this asset is now 90,000, not 1 lakh, because already we have taken the service of 10,000. This is called depreciation because 1 year already gone. Similarly, second year, another 10,000 will be dropped. So we will be treated, this will be treated 80,000 asset value, not 1 lakh, because 2 years already passed. So 10,000, 10,000, 20,000 less. So depreciation is an expenses, Accrued expenses and accrued income. Accrued expenses means liability. What does it mean? Suppose electricity bill already incurred for this month, but we didn't pay it. So this amount, accrued utility bill or accrued salary, this is expenses. This is liability because the expenses already occurred, but we did not pay them. So accrued expenses is liability and accrued income is asset. Accrued income means we have already, say we make FDR for 3 months and we are closing our accounts now. That means in 2 months, still 1 month left to get the income from the investment FDR. So what we should here, that's mean accrued income. Already 2 months period income it generated. So this is an asset. Prepaid expense is asset because prepaid expense means we have already paid, but the benefit is yet to receive. For example, if we pay today advance rent for 1 month, what does it mean? It is not expenses today because we are paying in advance. This payment will allow us to use the premises for 1 month. So after 1 month, it will be expenses, but now it is asset as it is advance paid. Unearned revenue is liability. Similarly, if we get any advance amount from our customer, the service or goods is yet to deliver, then this revenue will be treated as liability, unearned revenue. This is not actually income, it is liability. Repair expenses. Any expenses related to fixed asset repair, building, machinery, furniture. So this is expenses. So that's all I think. Just I am summing up. The accounting equation is nothing but the combination of asset, liability, and owner's equity. There are two hands. One hand is assets, another hand is liabilities and owner's equity. Both will be always equal. If it is the beauty of double entry system. Every accounts, every transaction affects two heads of account. That's why these always balance. So that's all. Thank you very much. If you enjoy my lessons, you can subscribe my channel and make like button hit. If you want to know more about anything, you can make your comments so that I can reply later on. That's all. Thank you very much.